So take this building, or I own this building. I get to depreciate this building over a period of time.
26 years?
Depends. Depends on how you got it set up. You can accelerate depreciation, but the depreciation is different than a residential write-off. And the way the residential write-off works is very simple, but a lot of people don't understand it. So Sarah, let's say that you have a household income, we're going to use easy numbers, of $100,000. And let's say of that $100,000 that you're in a 33% tax bracket. I don't know exactly what it is, but let's say it's 33%. What that means is that let's say that you buy a home that's $500,000 and the mortgage on that home is say $2,000 a month, of which $1,500 of that is interest, $500 is principal. Let's just take that number, right? So that means that we're paying $18,000 a year in interest, right? So now we're paying $18,000 a year in interest, and we have $100,000 in income. So the government's going to tax you at $100,000, 33%. So they're going to take $33,000 from you. If you own a home and you have that interest write-off, it's $100,000 that you made less $18,000 of the interest that you paid on your home. So the government now is only going to tax you on $82,000. So that $18,000 gap at 33%, so a third, is $6,000 essentially net to you, which, when you think about that, $6,000 a year is $500 a month. So your mortgage payment that you're paying $2,000 for, of which $500 is going towards principal, which is your own savings, right? So you're only paying $1,500, but you get another $500 a month back because of the deduction. It really only costs you $1,000 a month to live in that home.
Now that's traditional.
Mm-hmm.
And then so what's the difference now commercially?
Well, commercial, it's the depreciation factor, which is the huge thing, and it's massive, right? So you take, let's say, for example, let's talk about the tax on that. So what you typically want to do is you want to put the building into another entity, a different entity, a holding company. So this holding company now owns this asset of a building, okay? Now let's say that we have a mortgage on that building. The building, like take this place here. Let's say we collect $60,000 a month in rent, okay? So the building has income of $60K. That's $720,000 a year in income that the building company would have to pay to the government. $720,000 in income. But we also have expenses. We have an HOA at this building, actually. We have administrative staff. We have things that get broken. We just had to fix the fire sprinkler system. That was probably $100,000. So we have all these write-offs to go against the $720,000 that we spend, or excuse me, the $720,000 that we brought in as income. We also have a mortgage, okay? So when you tally up all this, you come to a number. It spits out a number, and that's the net income of the building. Now,
the mortgage is taken away from that profit too, or from the income, right?
Yeah, so let's say that our mortgage on the building is say $20,000 a month, $25,000 a month, whatever it is, right? That's an expense to us.
Got it.
And we offset that. So the income from the rents pay the mortgage and then pay the expenses, which then spit out a net number that we have of our net revenue. But the beauty part of that, so that's the number that the government would look at and say, okay, you actually made this amount of money. But then when you tack on the depreciation of the building is where everything gets very beautiful. Because now, let's say this year, I think we wrote off $800,000, $900,000 in depreciation. So now we actually have a loss carry forward because we actually lost on this building, believe it or not. Even though our rents paid the mortgage and we had excess and it still covered the expenses and we still had income, the depreciation allowed us to offset that income where we actually have a loss that we can take against my own personal income. And so now instead of me having to pay, like we started this discussion by saying I have $720,000 in income, right?
Yeah.
Well, at 35% to the government, say that's the number, I don't know what it is, but let's say that's the number. All of a sudden now, 720, I got to stroke a check for $15,000, whatever that is, right? 230. Now, guess what? I actually don't have to stroke a check at all, and I get to use money to offset my personal income to where I have to pay less taxes.
That's the part where I get confused. Like, so you have this separate holding company for this building, but then how does it?
So they issue what's called a K1. So now the building, for the year 2021, let's say the building had a $500,000 loss, which is actually what I think we had. And there's 4 partners, so we each got a K1 of $125,000 negative. So let's say, doesn't matter, but let's say I make $500,000 this year, right? I now only made, to the government, I only made $375,000.
Yeah.
So instead of me paying taxes on $500,000, I now only have to pay taxes on $375,000. That's an easy way to like calculate it.
Yeah.
Now let's say I make $10 million a year,
Yeah.
okay? Now we take all these buildings that we own and everything else that comes in between. And that's why I said I will never, ever, ever rent a commercial building again, because I now own, we just bought the Civic Center one, that was close to $9 million. I have my buildings down in downtown Phoenix. We have the waterfront one. And the reason I'll never rent again is because I never understood how big of a value depreciation is against offsetting of your income if you structure it the right way.
Yeah.
It's incredible. So that's why when you talk multifamily, when you talk commercial, that benefit of depreciation far outweighs anything to do with any type of what would be a residential interest deduction or whatnot. Now you're playing at a bigger scale, of course, but in the residential space, the thing is people don't understand that. People don't understand what do you mean by interest is deductible? What do you mean by that? Well, what it means is that you don't have to pay taxes on it because it goes against your income. Now let's say you have a $1 million home. Now there are limits, and I don't know the limits right now because they changed them, but let's say it was all deductible, all the interest was deductible, which it used to be that way and they've changed it a little bit. But let's say, for example, you got a $1 million home, you got a $5,000 interest payment on your home. Okay, that's $60,000 a year. And let's say that the guy that owns that home makes $200,000 a year, right? Well, if his tax, because the more you make, the more they take, right? Tax brackets go up. So let's say his tax bracket's 35% at $200,000. Okay, so that's $70,000 that he has to pay to the government every single year. That's gone. He's got to pay that, right? But he's got a $60,000 deduction against his house. So he's not making $200,000, he's only making $140,000. So not only will that bump him down a tax bracket, because he's not in that 35, maybe he's at 32, and now he's only got to pay 32% on the 140 that remains. So that savings is huge. It's huge. And in most cases, when you think about it, like when you look at the cost analysis worksheet that we use and show our clients, just that offset of having interest deduction from your home and what you save against your taxes is almost typically 1.5 months of work. Think about that. Just by owning a home, he has increased his income 1.5 months of work. Or, guess what? If he doesn't own a home, he's cost himself 1.5 of months income. Think about how that's 6 weeks of work.
Yeah.
Like you get, just by owning a home, you get 6 weeks of work in addition, additional pay because you own a home. That's crazy.
That is crazy.
Right?
That's interesting. Yeah.
So when you start thinking about how impactful that is, and really, and by the way too, here's another important factor as well. That's net, okay? And what I mean by net is, in order to take home 10, you gotta make 14, right? So gross versus net are two totally different things. This is net. So 1.5, if you're 30%, really is about 2.1 to 2.2. That's a sixth of the year. That's a sixth of the year that you just get back because you own a home. And so when you break down all the key components, principal, your payment never going up with inflation, principal pay down, the interest deduction. If you get 6% appreciation a year, which is about the average over the history of history, not 20 like we're seeing now, but even at 6%, when you put in all these factors in play, that's why I always say if it's for you and you're going to be in your home a while, the only time is now. Not, oh, well, we're going to wait until, my argument is, since 2014, everyone's been, 2015, oh, the market's too inflated, it's too inflated. The market's up 100% since then. For those that continue to say, I'll wait, it's going to go down, well, guess what? Is it worth what happens when it doesn't. Because what ultimately ends up happening is these critics out there that always want to predict the market that lose. People that are smart in real estate know if you're going to buy your home for yourself, you always do it now, especially in the interest rate environment that we're in. But the ones that criticize that and say, I'm going to try to time the market perfectly, guess what? They've lost year after year after year after year after year after year that they've been continuing to say that. And what has happened? Two polar opposites. Take somebody in 2017 that said, I would like to buy a home, but I think we're at the top of the market. And they were looking at 400,000. Over the past 4 years, since 2017, at an average, if they're looking at, say, 400 grand purchase price, they're probably paying 2 grand a month in rent. And let's say that we didn't have rent inflation. Let's just say we didn't. Let's say they paid 2 grand for the past 4 years, okay? That's $100,000 in rent that they just lit on fire, and they have missed out on a market that has appreciated 80% in the past 4 years. So that home that was 400 is now worth 700,000. They would have made $300,000 in equity, paid down principal on top of that, so they didn't owe 4 anymore. Now they only owe 365. So that's another 35,000 bucks, right? Over 4 years. So they've made $335,000 here, or you just wasted 100 here. I just told you before we started this. Think about that number. I wasted 100 and I have 335 in here if I would have bought in 17 versus continuing to rent. That's $435,000. Do you know how long it takes someone to save $435,000? Most people will never have that in their bank account ever. And if that guy didn't buy a home, he probably never would have that money. But in 4 years, he created a retirement account for him simply because he bought a home rather than rent.